Howdy. If you have been on the internet searching for homes, you've probably also been looking at mortgage calculators, and you may be wondering what makes up my mortgage payment. Let's talk about that for a minute. There are several components that make up your mortgage payment. The biggest is principal and interest, or we call it P&I, principal and interest. Everything in real estate has acronyms. Yeah, principal and interest. So what that comprises of is the amount of money that you are borrowing, and we're going to assume that you're buying a $175,000 home so we can work with some of these examples. So the principal would be $175,000, and then the interest depends on what your interest rate is. So principal and interest on a $175,000 home per month, if your interest rate was 4.5%, would be $886 a month. Let's play with that a little bit. If you kind of missed out on that interest rate, because interest rates are about 4.5 today, well, let's just say that the interest rate was 5.5. If it was 5.5, then your monthly payment would jump to $993 a month, which is about $107 a month difference. So you can see how that starts to impact it. Well, what if you bought a bigger house? Okay, so we'll go by find your bigger house. You say, I want a $200,000 home. Well, at 4.5%, you're looking at $988 a month, and then at 5.5%, you're looking at $1107. So hopefully that sheds a little bit of light on how your principal and interest works into your monthly payment. It's the biggest part of your mortgage. Next would be taxes, and taxes is something we cannot avoid, but let's talk about it. What happens is if you buy a home, your mortgage company wants to make sure that your taxes on that home are paid, so they actually include that in your monthly payment. If you were to buy a $175,000 home in Nashville, your monthly tax bill would come out to about $133 a month. It's about $1,600 a year. And then you can see how it drops depending on where you buy. Smyrna, 108, Mount Juliet, 92, and these are just approximations to give you an idea of how buying in different areas changes your monthly payment with taxes. Okay? The next big part of your monthly payment is hazard insurance, or really just what we call homeowners insurance. And that insures your home against things like fires or burglaries, or if a storm rips through. Your insurance company helps you rebuild the home. Okay, well, if you were buying a $175,000 home in Nashville, you could expect your homeowner's insurance to run you about $700 a year, or about $58 a month. Now let's talk about insurance for a second, because there's some things that can impact how much your homeowner's insurance is. Things that have a small impact would be things like if you buy in a high crime area versus a low crime area. Typically, a newer home is going to be a little bit less than an old home. Even your credit score has an impact on your homeowner's insurance, but those things have a small impact. And I'm just going to give you a tip. The biggest way to impact your homeowner's insurance cost is who you buy with. Okay, so when you go to get your homeowner's insurance quote, get several quotes, and here's why. An insurance company looks at a home as a risk. For example, if a tornado ripped through an area, an insurance company does not want to insure all of those homes. They only want to insure a small percentage of the homes. So our trick is to find that insurance company that's looking to increase the market share of the homes that they insure. Because if they're looking to increase the market share, they're going to have lower prices. And so that changes from time to time. So what you really just need to do is call around, and I can help give you some numbers. Another quick tip, let them quote your auto insurance as well. Don't you love those photos? Let them insure your auto as well, because that will save you a lot of money, and that's important. We're talking about monthly payment here. The last thing that goes into your monthly payment is mortgage insurance. We call it MI. If you are putting less than 20% down on your home, then you have to have what's called mortgage insurance. And basically what that does is it insures the mortgage company in case you walk away from the home or stop making your payments. They're not on the hook. But let's talk about that. You have to have mortgage insurance unless you put 20% down, or a couple of exceptions would be if you're a veteran. Thank you for your service, by the way. You don't have to have mortgage insurance if you do a VA loan or if you do a rural development loan. But most of us, if we're not putting 20% down, mortgage insurance is something that we're just going to have. If you were a first-time home buyer, or if you're buying a home, you haven't bought one in the last 3 years, you can do an FHA mortgage. Your mortgage insurance would come to about $125 a month on that $175,000 home, just to give you an idea. So that's what it works out to. You have to have that mortgage insurance for a minimum of 5 years, okay? And then after that, it's just a matter of when you have that 20% equity in your home. And you're going to get that 20% equity because hopefully your home value is going to rise every year. And then also you're going to be paying it down. So eventually you're going to have that 20%. And then you just tell them, hey, you know what? I've got 20% equity. They'll check it out. And then your payment will actually drop because that'll come off once you have that all taken care of. So hopefully that explains it a little bit. Let's break it down. So we go out, we find a great house in Nashville. That's $175,000. Your principal and interest is going to be $886. Your taxes are going to run about $133. Your homeowner's insurance is going to be about $58, and then your mortgage insurance is going to be about $125 a month. Okay, and what that works out to is calculator on $1,202 a month. Okay, hopefully that gives you some insight. And if you have any questions about any of this, please feel free to give me a call or contact me through the blog. I'd be happy to walk you through it. Thanks for paying attention.